Thank you very much, and it's great to be here. I'm going to talk about a topic today that everybody knows a lot about, actually, but there's some surprising aspects to it. I know, and I'll probably walk around a little bit. I've got a mic up here. Everybody knows about liquidity. I'm going to actually suggest that it can be an investment style. It's one of the key drivers of returns. By the way, I am a chairman of Zebra Capital, and we do manage money. Really, full disclosure up front that we manage money on the basis of these concepts that I'll talk about today. But I'll talk about it more in the conceptual level today rather than the specifics of how we manage the money. I'm still a professor at Yale. A lot of you actually know me, though, I think, from Ibbotson Associates, a company that I sold to Morningstar 6 years ago, but I ran Ibbotson Associates started it and ran it for many years before actually embarking on Zebra Capital. All right. So what is meant by liquidity? Liquidity actually means a lot of things, and it's always in discussion, especially after the financial crisis. And I guess it's been mostly talked about as liquidity in the financial system, because in the financial system we had this shortage of liquidity. We didn't have high enough savings rates. Of course, now we end up with the low interest rates after the fact, and but there was basically liquidity means easy access to capital. Well, that's not the context I'm going to talk about it today. Closer to it is liquidity in trading. And liquidity in trading means things like low transaction costs. There's a lot of trading volume, not much impact when you're trying to put your large orders in. Well, that's close to what we're talking about today, but what we're really going to talk about is liquidity and valuation. Because there may be some higher costs to trading and liquidity, it actually has a big impact. Because if you want something very liquid, it's a basic principle here, that if you want something very liquid, you have to pay extra for it. And if you're willing to give up some liquidity, and actually what I'll be talking about today is I would think, giving up very little liquidity, but giving up some liquidity, even staying in public markets, but going from the most liquid to not quite as liquid, you can get extra returns. So in valuation, well, we all like liquid securities. Why wouldn't we? They're the ones that are easier to trade. They don't have much market impact. The problem is that they're higher priced. You have to pay for that liquidity. And, of course, if you really are a rapid trader in some way, if you're doing a lot of trading, and some of us certainly fit that category here, if you're one of those kind of people, one of those kind of investors, you really want the most liquid assets. It's worth it for you to have the most liquid assets because they're going to actually save you some costs. I think actually most of us all actually fall in the second category, though, because the less liquid assets, although they're more difficult to trade, they end up being lower priced for the same set of cash flows, and that's what gives you higher returns. So if you have a little longer term perspective here, the lower liquidity assets actually give you the higher returns. And so the real key comes to the mention here at the bottom in blue. Don't pay for liquidity you do not need. Liquidity is in fact something to be managed and appropriately managed. So there is a liquidity premium, and it's very substantial. I'm going to show you how substantial it is, even in public markets. In my former company, Ibbotson Associates, I'm used to coming up with what we call stocks, bonds, bills, and inflation charts. And this sort of looks like one of those. Because in those stocks, bonds, bills, and inflation charts, we were interested in looking at the different premiums in the marketplace. And you're starting out with that on the base level there, at the bottom. Whoops. I have to back. I thought I had a pointer. I think I do have a pointer here, but I don't know if I have a pointer on this or not. But the very bottom in gray, we have the riskless rate. The black line there is just the Russell 3000 index. You can look at the Russell, though, value index in green and the growth index in yellow, there's a value premium and a growth premium. What's actually going to be the most powerful premium of all, though, is this liquidity premium. In fact, so a high liquidity portfolio turns out to be the red line. It actually does worse than the overall market. And a less liquid portfolio, it turns out to be the blue line on top. The less liquid, it does better than the overall market. Oh, here's a pointer. Okay. Thank you. So I don't have to point with my... You got everything here. You pull up the right thing. All right, and by the way, I'm not the first to speak on this topic. There's actually about 30 years of literature on liquidity. Most of the literature, actually, though, is in the bond market, or it is in alternative markets, of course, like private equity markets and so forth. People talk about liquidity all the time. And there's also quite a bit of literature even in the equity markets, which I'll talk about today. I'm talking about today publicly traded equity markets, where we're just talking about going from less liquid to more liquid. But there's still, everything I'll talk about today concerns stocks that trade every day. They may not trade every minute. And I'll give you an analogy in the bond market, because so much of this literature actually is in the bond market. In the bond market, they have a on-the-run yield curve. And those are the most liquid bonds, and they have it in almost every government market, treasury yield curves. Then they have an off-the-run yield curve, and there's a spread between the on-the-run and the off-the-run yield curve. And that spread is the liquidity premium. And you can actually see it in the bond market. And the interesting thing about a treasury, if I go to the U.S. Treasury market, which I guess I know the most about, and in fact I once managed bond portfolios, in those markets, that spread is about 20, 30 basis points. And it's a spread basically from a set of bonds that trade every minute versus a set of bonds that might trade every 10, 20, 30 minutes. Well, interestingly enough, giving up a few minutes of liquidity might give you 10, 20, 30 basis points extra potential return. That's sort of the realm that we're talking about here. And in some ways, you can think of what I'll talk about as talking about off-the-run equities here. They're still going to be very liquid. It's just that they're not as liquid as some other securities. So let's think of a style now. It's really going to be like a beta. Because if you think of what is a style, when we talk about equity styles, it should be something that explains long-run returns. It's not some edge you have for the moment, some scheme or something to beat the market. It should be something that should actually provide a long-run return. That's the first thing you should get out of a style. The second thing is, of course, the existing styles that are most prevalent, most well-known, and most accepted in the markets are size, value, and momentum. And any other style, if you bring to the table, should be different than the existing styles. And the third criteria to make something a style is it's something that should be pretty stable. It's something that shouldn't require rapid turnover to handle it. It should be relatively lower turnover portfolios over time. So I'm going to, the title of the talk today is Liquidity as an Investment Style. I'm going to basically try to convince you here that liquidity is an investment style and that it meets these three criteria. So we'll first talk about explaining long-run returns. Well, what does explain long-run returns? First of all, it's market or beta risk, small stock premium, value premium, liquidity premium. If you're in the bond market, it might be the horizon premium, default risk premiums. There still is the same liquidity premium in the bond market. Those are the kinds of things that explain long-run returns without your specific strategy here. And I'm certainly going to argue that liquidity fits today in the equity market. It's really accepted that it fits in the bond market. So I'm going to show you a study. This is a paper that I've worked on a couple papers here. And a paper where we look at the U.S. market, the top 3,500 stocks, and we're going to compare the returns. We'll show you some grids, comparing the returns of different liquidity and stocks compared with size, value, and momentum. We're going to measure size the way you always would, which is capitalization. We're going to use value with earnings to price ratios, EP ratios. Momentum is just previous last year's returns. And liquidity we'll measure by trading activity or turnover rates of the stocks. And we'll set up some matrices, and we'll do this very simply here. We're just doing the simplest strategy you can imagine, annually rebalancing these strategies, and let's look at some of these results. First, size. Size is perhaps the longest, long ago discovered kind of style. Actually, Rolf Bonds was discovered at the University of Chicago, and I was on his dissertation committee at the time, and he graduated in 1980, and it showed that that small caps outperform large caps. Well, that's not necessarily going to be as true when you look at it in the context of liquidity. This is a grid of the columns here. We're just taking all these 3,500 stocks and putting them into quartiles. So if you take 3,500 and divide by 4, that's 875. So there's 875 stocks in that fourth column. And so that fourth column has 875 stocks. The first column, which is shaded, has 875 stocks. The shaded column are the least liquid 875 stocks. The fourth column are the most liquid 875 stocks. You do the same thing by capitalization. The smallest capitalization are the top row here. Those are really microcaps. The largest capitalization may be the large caps. I guess I kind of think of it as microcaps, small caps, mid caps, large caps, roughly the categorizations here. And then look at the returns. Now, if you cut across the liquidity quartiles here, say in microcaps, there's a very big difference between the less liquid and the more liquid microcaps. And that difference is from first quartile to second quartile is actually over 13%. It's true for all these different rows, although it's less true for the large caps. But even in the large caps, it's about 2.5%. So even 2.5% is not a trivial number among you portfolio managers and so forth. So even there, you get big differences between the less liquid and the more liquid quartiles of publicly traded stocks. Now, interestingly enough, and this goes from 72 to 2011, so this is 40 years of data. And interestingly enough, if the famous, well-known small cap effect might be comparing the top row, say, with the bottom row. And it is true that for the less liquid stocks, the top row outperforms the bottom row. And there you find that small cap premium. You sort of find it across the board. However, as you get to more and more liquid stocks, particularly even the bottom half of this sample, it turns out that for the liquid stocks, the small cap premium is no longer a positive number. It actually becomes a negative number. And at the extreme here, these highly liquid stocks, it completely reverses. The worst number in this whole table, by the way, you can find it up in the northeast corner there. These are microcaps, but they're highly liquid microcaps. In many ways, I think of those kind of stocks, they have 2.56% return. those are your cocktail party stocks. They're not in big supply. They're small companies, but we're all excited about them. We talk a lot about them. The prices get way bid up, and they actually have the lowest returns. So